Hello financial fans, welcome back to another stock analysis. Today we'll be covering Kellogg's, stock ticker K. Kellogg's is a breakfast, cereals and snacks manufacturer. They currently have a market cap of $24.14 billion and their revenue in 2021 was $14.2 billion. Their dividend yield is 3.28%. Some of the brands that Kellogg's owns include Pringles, Rice Krispies, Frost Flakes, Austin, Cheez-It, Morningstar, and many more. 57% of their revenue is generated in North America, 19% in AMEA, which is Africa, Middle East, and Asia, and the remaining, and 17% is generated in Europe, and 7% is generated in Latin America. From their revenue, 52% is generated by snacks, 40% by cereal, and 8% by other stacks. For our final valuation, we'll be using a margin of safety to get rid of any inconsistencies that might be present in our valuation. This margin of safety will be based on financial ratios, financial health, and the growth of the company. Our standard margin of safety will be 25%. This can either increase or decrease based on the ratios that we'll get to in just a moment. Determining how much it will increase or decrease will be using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase in our margin of safety, orange will mean no change in our margin of safety, light green will mean a 5% deduction from our margin of safety, and bright green will mean a 10% deduction from our margin of safety. When we're using 3 colors, bright red will mean a 5% increase in our margin of safety, orange will once again mean no change, and bright green will mean a 5% deduction from our margin of safety. The first 2 ratios that we're going to look at are the EBIT growth and the margin growth. As you can see, the EBIT has gone up just a little bit from 2012 all the way to 2021, going from 1.5 billion to 1.75 billion. During this time, the EBIT has grown 9.3% on average, which means no change in our margin of safety. The margin has also grown a little bit over these 10 years. The average growth here was 9.01%, meaning a 5% deduction from a margin of safety. The next 2 ratios are the dividend growth and the payout ratio. As you can see, the dividend has steadily gone up from $1.56 a share annually in 2010 to $2.32 a share annually in 2021. The average dividend growth during this time was 3.7%, meaning no change in the margin of safety. The payout ratio is sitting at a solid 53.6%, meaning no change in our margin of safety. The final 2 ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To get our debt to EBITDA ratio, we have to take the debt that Kellogg's is bearing, deduct the cash from it, and then divide it by the EBITDA, meaning the amount of years of EBITDA that it would take to pay off all the debt. In this case, it's just over 3 years, meaning 335% debt to EBITDA ratio, which is a 5% increase to our margin of safety. The return on invested capital for Kellogg's is sitting at 7.7%, meaning no change in our margin of safety. Let's go look at the valuation models next and determine the intrinsic value of Kellogg's. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow from 2018 to 2021. I haven't imported any before this, since there were some negative free cash flow years in this, which would lead to incredible average growth in the cash flow. Out of these years, we get an average growth of 30%, which is of course very high, seeing as we only took a couple of years. Because we're calculating the lifetime expected growth of the company every year, I've gone with 20% of the average growth, which is very low, coming in at 6%. Since we're trying to determine the lifetime expected growth of Kellogg's, I've gone with only 20% of the average growth, which is still 6%. This 6% then will be used to determine the future free cash flow of Kellogg's, and we'll be determining a terminal year of valuation using a perpetual growth rate of 3.5% and a discount rate of 8.5%. Summing up all the present value of the future free cash flow, we get a sum of free cash flow of $27 billion, just under $27 billion. To get our equity value, we have to add the cash and equivalent and subtract the total debt. Doing this, we get an equity value of $19.5 billion. To get a discounted cash flow price per share, we then just have to divide it by the shares outstanding, which is 341 million shares. Doing this, we get a discounted cash flow price per share of $57.26. With the current price of $70.73, this is a downside of $13.47, which is a 19% downside. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts from 4 years ago to the current year. During this time, the average growth rate in dividends was only 1.5%. Seeing as this is a very low growth rate, I've chosen to do the expected growth rate in the future at the average that we looked at earlier when determining the dividend growth in our margin of safety calculations. Once again, we'll be using an 8.5% discount rate. Doing the math, we get a discounted dividend model price per share of $50.44. With again the current price of $70.73, we get actually a downside of $20.29, which is almost a 29% downside. The last valuation model that we'll be looking at is the multiple valuation. By looking at companies that are similar to Kellogg's, looking at their stock price and earnings per share, we get an average PE ratio in the industry that Kellogg's operates in. In this case, the average PE ratio is 22.07. Then to get our fair value, we just have to multiply it by the earnings per share that Kellogg's is generating, which is $4.35. Doing this, we get a fair value of $96.02. With the current price of $70.73, the upside here is $25.29, which is almost a 36% upside. Let's look at the final overview of our valuation next. Coming to our final overview, we have imported the discounted cash flow price per share, the discounted dividend price per share, and the multiple valuation price per share. Out of this, we get an average of $67.91. We'll be using a margin of safety that we have determined earlier, using our standard margin of safety of 25%, adding 5% for the debt to EBITDA ratio, and subtracting 5% for the margin growth. Doing this, we get a fair value of $50.93. With the current price of $70.73, downside is almost 28%. If you wish to not use a margin of safety at all, then the downside would be almost 4%. I hope that you have enjoyed this video. If there's any companies you would like to see on this channel next, please let me know in the comments. Thanks for watching.